So the link for me is quite evident. So just to come on to what we're going to go through today. So I'll do a bit of a derivatives refresher. It may be the case that you know the stuff. In fact, I hope you know the stuff. But I would like to give you my spin on how I understand it. My brain works reasonably intuitively, right? So I put a few formula on the board already. These don't really mean much to me, right? Understanding about how we get to that is important, because knowing that intuition, it puts you in it makes you understand the concepts better, so you can apply them a lot more quickly rather than just relying on a formula in itself, okay? So we'll go through a couple of applications. We'll look at a wealth management application. So essentially you're a wealth manager looking to help a wealthy individual hedge their investment portfolio. Okay, that's scenario number one. Scenario number two, which is a little bit closer to Gallium's heart in reality, is an institutional application. Okay, so we will give the example of a pension fund that is looking to improve their portfolio diversification. All right. I've left a bit of time for Q&A at the end. In reality, ask questions at any time. I'm going to be asking you questions because I need to understand at what level you're at, because then I can assess essentially what I can discuss. So please try and make this as interactive as possible, all right, at the end of the day. So I'll be asking you questions. Feel free to ask me questions, okay? A few questions that we're going to answer throughout the session. Should we care about derivatives? I'll answer that straight away. We certainly should. If you look at purely volumes in terms of trade, the cash market is far, far, far inferior to the equity derivatives market, right, or the derivatives market in general. Okay, if you look at trends that we've had recently, if you look at the retail side of things, if you look at things like Robinhood, and you look at people getting cash into their bank accounts during COVID, there's been a huge boom in derivative volumes due to platforms like Robinhood, right? Retail getting involved in this market, and that's changed a lot of the market dynamics, and that's something that we're very aware of at Gallium, because they can affect some of the strategies that we work with, right? So that big retail boom has helped drive derivative volumes, and certainly that pales, you know, at the end of the day, it's sort of 100, 1,000 times what you see in cash S&P, cash NASDAQ, cash stock in general, okay? The other thing to consider is that derivatives have so many applications. Any corporates looking to stabilize cash flows, they'll be using derivatives. They'll be using futures, they might be using calls, they might be using puts. It's not just financial institutions or people with an investment portfolio that will use derivatives, right? They're really used across the world. Derivatives started in commodities, right? And now it's obviously ventured into things like equity, fixed income, and now derivatives are completely cross asset, right? But the use cases are abundant at the end of the day. And the two questions that we're going to answer is, how can a wealthy investor protect their equity portfolio? And then how can a pension fund diversify their portfolio critically without sacrificing liquidity, right? I don't know if it's something that someone's cottoned onto, but gallium, the name comes from a metal. Gallium is the metal that melts at the lowest temperature, so it very much links with liquidity. So at the core of all the strategies that we develop for our clients, we think of liquidity first and foremost. What's the point in having a hedging strategy if you can't monetize it, right? It's a really important part of any investment application, okay? So we're not talking about private equity, real estate here as alternatives. We're thinking liquid alternatives, okay? Stuff that you can monetize in and out, okay? So this is just a rehash of what I've effectively said, but what I wanted to point out, two things. The annex, I built this presentation around something that I did at a French business school a few years back, and I would say the level was a little bit lower, let's say. They're a little bit more younger than you guys, essentially, so they won't have had much more, they won't have that much experience in derivatives. But in the annex, feel free, I'm sure we'll make this available afterwards, this presentation, David. So we'll make this presentation available to you afterwards. Within the annex, there are a lot of scenarios that you can run through to understand some of the concepts that we're going to work with today. All right, so if there's something you haven't quite understood in the presentation, obviously put up your hand and ask the question if you wish, but you can always revisit towards the end. A lot of the slides are based around options, futures, and other derivatives. I assume you all know that book from Hull. Right, it's kind of the Bible. It's something that I studied. I'm sure it's come on leaps and bounds since I studied, but a lot of the material is taken from that book. And I've also built some Excel sheets which will be helpful for yourselves. So a lot of the pricing that we're going to run through today will be on Bloomberg. I would really recommend getting familiar with the Bloomberg terminal. If you're interested in equity derivatives, interested in derivatives in general, play around with Bloomberg, play around with pricing, look at volatility surfaces. It'll allow you to have an appreciation of the concepts that we're going to be working with today. But in the instance that you can't get a Bloomberg terminal, I provided you with an Excel model where you can price multiple leg options. It's just using Black-Scholes, so it's very, very simple, but nonetheless, Bloomberg uses the same thing. All right, there's nothing new. And I've also provided an arbitrage workbook, which helps us to get to solutions like that, okay, which is the price of a forward. Okay, so there will be some resources that we'll make available to you. So hopefully you have a lot more to take away than just me standing in front of you for 90 minutes. All right. So I want to look at a few concepts. These are simple concepts. They're concepts that you should understand. So I want to look at some sensitivities with a forward. Okay. So does anyone know how we get to this? What principle we rely on to get to this formula?
Continuous compounding.
This is continuous compounding, yeah, but the concept that fits around this formula.
It's not arbitrage.
No arbitrage, exactly, right, great. So it's the no arbitrage theory, right? So we have two options when we're buying or long an asset, right? Whether it be a stock or an index. We could buy it in cash, okay, so we can invest 100 and buy the cash underlying. That's option one. Option number two is we could buy it forward. Okay, so when you buy it forward, let's assume we're in a world of no transaction costs, no brokerage, etc. When we buy it forward, we're long the underlying, but we don't lay out any cash, right? So by principle of no arbitrage, what does that mean? Anyone? I'm looking at you because you need no arbitrage. If you have two portfolios, one where you're long the forward and one when you're long the cash underlying, right? What can you do with the forward? So what's left over? If you buy a forward, you don't put any cash down, right? All right? With the stock, you put cash down. So you've got 100 left over. So if I long a forward today, I've still got 100 in my bank account, right? Okay, I'll tell you the answer.
Invest it in the risk-free rate.
Correct, right, exactly. So essentially, if I'm going long or forward, I can take the cash that I would have invested in my cash stock or my cash index, and I can invest it at the risk-free rate. So by definition, by no arbitrage, the forward price needs to be adjusted upwards by the interest rate. Okay, so we continuously compound the spots, which is the price of our cash asset, which we gave 100, by the rate over a period of time. Okay, so that covers off essentially our first 2 points. Right, the higher is R, the higher this is going to be, and the lower is R, the lower this is going to be. Right, make sense? Perfect. Okay, these are really important concepts to understand because a forward, it is the core of pricing options. Okay, so you need to really understand those sensitivities. Okay, the second two, so looking at dividends, that's an extension, which is here. Again, I want an answer from the audience this time, because I've given you the answer, it's just a cash flow that's slightly different. So how do we get to this principle? If we've got two portfolios, one where we're long or forward, and one where we're long a cash asset that pays a dividend, okay, how do we get to this?
If we are owning the forward, we won't receive the cash dividends because we are not actually owning the underlying asset.
Yeah.
So we have to remove that. So like, if you were just owning the underlying asset, we would have more money at the end because we would also receive those cash dividends. Which we
Correct, yeah. So it's a little bit the other side here, right? So with the forward, you'll earn, you increase the forward price by the interest rate because you earn that on the cash that you have aside. But when you buy the stock that pays a dividend, when you long the forward, you don't receive that dividend, right? So only the cash equity investment or stock investment, whatever you want to say, will receive that dividend. Okay, so by that virtue, we need to discount our forward price by D, which is our dividend rate. Okay, we continue to compound it, so effectively we get R minus D times by T. Okay, so the higher your dividends, the lower the forward, right? And the lower your dividends, the higher the forward. All right, and all forward pricing essentially is a relationship between R and D. Okay. So to demonstrate these, I won't run through it today, but you can go to the annex afterwards and you can see how you can do cash and carry or reverse cash and carry to effectively prove that. Okay, so that's a fundamental concept that people need to understand. And remember that, it's very important. Now, in finance we don't use this. Well, I don't use it certainly. Right? It's a bit of a, it's an over-complication, I would say. So if we just go through a very simple example, right? So we've got a stock that's worth 100% or $100 if you wish. Dividend yield of 2, okay, and interest rates of 5%. So our risk-free rate is 5%, okay? Very easy. We do the price minus the dividend yield plus the interest rates, okay? And our forward price comes out to 103. Okay, so in this instance, because interest rates are greater than dividend, okay, our forward is going to be above our spot price, okay? So can you do the same for the 3-month forward? Can anyone do the calculation?
100.75.
Correct. Good man. Perfect. All right, so what we've simply done is these are compounded, we assume these are annual rates, right? So we just divide those by 4, because it's a quarter. Okay? Any questions? Is that simple stuff? No? Okay, good. Right, so coming on to some sensitivity with options. So we're looking at now non-linear derivatives, essentially. So looking at those hockey stick payoffs that hopefully we all know and love. I certainly do. The first thing I'll say, so this is lifted straight from Hull. Right? I can't remember what page it's on, but it's exactly the same. For me, ignore this. Right? I don't know within your course whether American options are priced or looked at. Practically, we don't use them. In the 15 years I've been working in derivatives, I've never priced or traded an American call or an American put. Right? So we stick firmly to the European side of things because it's a little bit more practical, it's a little bit more used. So in terms of sensitivity, so what we're looking at is we're looking at the price of a European call or a European put, and we're looking at how that's affected by the current stock price and the strike price. Okay, so based on what you know about options, okay, can someone explain why there's a positive relationship with the current stock price and the European call price, and why there's a negative relationship with the strike price?
If the current stock price increases, my payoff becomes positive and I earn money.
Correct.
But if the strike price increases, I will have to cross a higher threshold to make money.
Exactly. So you're looking at max of 0,
And
S minus K. Exactly. So if by definition European puts, it's the other side, right? Because the formula is max of 0, K minus S. Okay, so those sensitivities are quite easy to understand based on the payoff of an option in itself. Okay, I'll skip time to expire for a second, but volatility. Why is it positively related to volatility for both European puts and calls?
There's a higher probability of my payoff actually paying off because I have a right, not an obligation.
Exactly. So you're right in what you're saying, but my intuition is slightly, I'd say, a little bit more simple. It's insurance. Think of it as insurance, right? If you've got, which is the same principle as what you're saying, but it's an insurance contract. Right? If you buy a put, you're paid off if a market falls. Okay, so you're insuring your portfolio. Okay, so by definition, if you've got higher volatility, the likelihood of a big payoff is big. So by that virtue, the insurance should be more expensive, right? It's like if you insure a house that's already burned down 5 times in the last 50 years, clearly the volatility is high, essentially, so you're going to pay a lot for your insurance premium the next time round, okay? All right, so risk-free rate and amount of future dividends. Coming back to this here. Right, they purely depend on the forward, all right? So if our risk-free rate is positive, or if our risk-free rate is high, it means that we're in the money forward, right? So essentially, our forward is above spot, so our European call is going to be more expensive, right? Because if we think about in the money forward, it's not in the money spot, it's in the money forward. There's value to that, okay? So of course, if you've got high interest rates, you're in the money forward, your put is going to be out the money forward, okay? Because it's the other side of the equation, okay? Your forward is up, above spot, sorry, rather than below spot. And it's obviously vice versa with the amount of dividends, okay? Now, time to expiry. Why is this ambiguous? Has anyone can hazard a guess or knows why what might be the case? Why there might be ambiguity over the time to expiry? Because
It depends if you're buying or selling the call. Like, if I am buying the call, the time works against me. Right?
I see your point, but it's not quite. So when if we go down to insurance, right? How I understand it initially is assume we're in a world with no dividends, no interest rates, right? If I insure a house for 6 months or I insure a house for a year, I would expect to pay more for a year contract than 12 months, right? So what would it be about, and it's something to do with the forward, right? What scenario could we be in where actually a longer term contract, a longer term option, a longer term insurance could actually be cheaper than a shorter term insurance?
Actually depends on the duration of the contract.
But yeah, both essentially the duration is going to be, let's say it's 6 months or 12 months, right? Essentially.
Okay.
Okay. I'll tell you the answer. So it's to do with dividends. Okay. So in a scenario where you've got a 1 month option or a 2 month option, imagine you have a big dividend paid in 6 weeks, right? So after the maturity of the first option, but before the maturity of the second option, 2 month option, right? In that scenario, the forward may be much lower for the 2 month option compared to the 1 month option. Okay, so in that scenario, actually the 2 month option could be worth less than the 1 month option because of the forward, or worth more depending on whether it's put or call.
understanding. But wouldn't we price those options based on based on the dividend yield which would be spreading it out?
So you make a really good point, right? In reality, the assumption that we make here is that dividends are compounded at a continuous rate. In reality, that doesn't happen, right? Because companies pay, if we look at a stock, for example, companies pay dividends at certain periods of time, okay? With indices, it's a little bit different because you can sort of apply this continuous sort of dividend yield approach, right? But with stocks, it's less the case because there are dividends and cash payments are not necessarily done on a regular basis. Does that make sense? Okay, great. Cool. All right. So we'll move on from here. So we've gone through a few of the sensitivities. I want to show you this rule of thumb, this approximation. This is an interview question that I had when I first started. The guy that I'm now working with, my business partner, had the audacity to ask me this. I didn't answer it correctly. So I put it in the presentation because maybe some mean person that's interviewing you will ask you it, right? So you can use this rule of thumb to price essentially an option with a flat forward. Okay, so if we assume no dividends, we assume no rates. So the forward price is equal to the spot price. Okay, we can use this. That doesn't exist, right? This is theoretical, but it's a good test case and it's a classic interview question, right? We can, if we set volatility at sort of 10%, right, and we set our time ratio at 3/12, so a quarter, right? We can essentially do square root of a quarter, so we get half here, right? We times that by a volatility of 0.1, we times that by 0.4, and you get 2%. Okay, I'm going to demonstrate why that works in a minute on Bloomberg. Why are we using 0.4? Does anyone know what the delta of an option is at inception?
Should be technically 0.
At inception, and at the money option at inception. So when an option's at the money, what's the probability it will be in the money or out the money? If you've got a flat forward. 50%. There we go. Thank you, David. So essentially, essentially this relates from that. I'm not going to go around to the in-depths of why it's the case, but it stems from the delta of the option being half at inception. Okay, so I'll now just prove that to you, and hopefully if this is set up correctly, let's have a look. Deal 1. Is anyone familiar with option pricing in Bloomberg? Oh, is it? Oh, okay. It's a really tricky mouse.
Is it on the surface?
Yeah, it's on the surface, yeah.
Yeah, you might have to just literally click hard with it.
No luck.
Here's the time to explain what is flat forward.
What is? A flat forward. A flat forward is when the forward price equals the spot price. Right?
There's
So
no inflation or whatever.
there's no interest rates. Right? So if the risk-free rate was 0, okay, and dividends was 0, that's a flat forward. So where the forward price equals the spot price. Because if you don't have a flat forward, you can't use that approximation, right? Because the option's not technically at the money forward, it's either in the money forward or out of the money forward. Okay, so you couldn't use that approximation. Right? So essentially, with no rates, you would delete this, and with no rates and dividends, you delete this part. Right? So forward just equals spot. Okay. How are we getting on?
It's got a yellow cursor, so I'm thinking that it's not responding. That's okay, that's okay.
Oh, there we go. Good. Okay, cool. Right, so has anyone seen this screen before on Bloomberg? Yeah? So you know the option value screen? It's function OV. Okay? So it doesn't really matter what underlying I'm picking here because at the end of the day, I'm going to change the parameters just to demonstrate what I've shown. So I'm pricing a vanilla put. Okay, it doesn't matter whether I do a call or a put. At the end of the day, when the forward is flat, the price will be the same. Okay, 90 days, so that's my 3 months. Okay, I have put 0 rates and I've put 0 dividend yield, so I've got a flat forward. Okay, and then I have put the volatility at 10%, so I've pre-specified that. You can see the price comes out close to 2. Okay, so it's a really, really good approximation, right? And it is a classic interview question. Okay, so I would argue that they're not going to ask you difficult time ratios, right, to do in your head, but they might ask you a quarter or 3 months or whatever it may be. But it's a good approximation to have. All right. Now, just to demonstrate where it wouldn't hold, if we put rates at 4% here, you can see that the price of our option goes down, right? At the end of the day, our forward has increased, right? So our option, it's a put, is now out of the money forward. So it's natural that we pay less for that option, okay? We'll do a bit more pricing in a bit, so you'll see a little bit more about how that works. Okay, so a couple of questions just to discuss. If you are selling a put option, right, and when you're selling a put, you want to try and generate as much yield as possible, as much return, so you want to get as much premium as possible. Let's assume you've got a constant volatility, okay? Which is going to be cheaper? So actually, which is going to generate the least amount of money? Is it going to be a put on Procter & Gamble, right, which is a US blue chip, essentially, or Apple? Anyone can anyone
What
guess?
is PG?
PG is Procter & Gamble. It's the ticker for Procter & Gamble.
Is that more volatile?
So assuming constant volatility. So assume the volatility is the same on both these stocks. Because yes, you're right, the volatility on Procter & Gamble is probably a lot less than the volatility on Apple.
Apple would be cheaper because PG would give out more dividends.
Correct. Yeah, exactly. So your forward would be lower on PG, right? So it'd pay more return. So the cheaper option would be Apple. Okay? So actually you'd prefer, in reality, you'd want to sell a put on Procter & Gamble because you get more bang for buck, you get more return. Does anyone know the concept of a reverse convertible? Which is a structured product. Anyone heard that name before?
No.
No?
Can you explain it?
A reverse convertible?
Yeah, can you explain it?
Yeah, of course. So a reverse convertible is very simple. It's simply selling a put. That's all you'll do.
Setting up good.
Selling a put, yeah.
Okay.
So you sell a put option, you take on risk that the underlying falls. Okay, so you would have a 1-for-1 exposure to the underlying, assuming your put's out the money, and you get paid a return for that. Okay, that might be 2%, that might be 10%, it might be 25%, depending on the volatility, the dividend, the forward, etc.
So you're the selling counterparty of a convertible.
Correct, yeah, you're the other side of it.
Okay.
Mind to repeat again in simpler terms?
Yeah, the reverse convertible?
Yes, yes.
So a reverse, you know what, maybe I'll draw it, because it's easy to draw. So, a reverse convertible looks like, can you all see if I draw here? Yeah? Okay, good. Alright, so a reverse convertible simply looks like this. Right? And you put some axes, and forgive my drawing, because it's not what I'm very good at. Alright, so that's out the money. Okay, you've got a 45-degree line there. It's not quite 45 degrees, but for argument's sake it is. So essentially, if your stock finishes above here, okay, your put expires worthless. So you've sold that put, so you receive your premium, and you've got no more risk. Right, so you pocket that premium. Okay. In the event the stock goes down, the risk is on your shoulders. Right, so you have to pay the person that you sold the option to. Okay, so if the option is down, if we assume that option strikes are at the money, if the stock is down 20%, your loss would be 20%. So you receive back 80% of your capital. That is a reverse convertible. Right? It's the most simple structured product there is, and you're simply selling an option. That's it. Again, you can get funky, you can do barriers, you can do out-the-money options, out-the-money strikes, but broadly at its heart, it's simply selling an option. Okay? We'll see a slightly more advanced concept of how institutional clients do it, but broadly it all boils down to that payoff. All right? So I won't go on the second one because we're a little bit tight for time, but again, feel free to look at it in your own time. So moving on to an application, a wealth management application, we've got a very lucky lady that's made a huge amount of money in the equity markets. So she's got a $35 million equity portfolio. Okay, she's young. She's been invested in the market since the end of 2020. Okay, so she's ridden a very, very good rally for a few years. 2022 perhaps not great, but 23 and 24, she's seen double-digit returns for her equity portfolio. Okay, in total, she's gained around 38-40% from her investment portfolio. Okay, they're driven. Performance mainly is driven, as we can probably expect nowadays, with AI and tech and so on and so forth, by a few players. So we've got Supermicro, that's SMCI, is the last ticker on the right. We've got Tesla, and we've got Nvidia. Okay, so again, you can use these. Type these tickers into Bloomberg and you'll get the page about the stock, the information, and so on and so forth. So she's anxious, basically, about the possibility for equity losses in 2025, right? You've got Donald Trump at the helm. You've got the potential for slower growth because he's not making his mind up on tariffs. You've got a potential for interest rates to rise because tariffs can be inflationary. There are a lot of things to be worried about from a macro perspective in the market today. On top of that, when you see the S&P 500 doing more than 20% 2 years in a row, you tend to get a little bit nervous. Right? So understandably, she's made good money from equities. She wants to protect her gains. Okay, so that anxiety is what's driving this discussion with this wealth management investor. Okay, so I want to ask a question to you. What options does she have? Right? Doesn't necessarily need to be derivative options, right? But what could she do? If you're a wealth manager, what would you advise her to do? There's no wrong answer here, right?
You could just buy a put on like the S&P 500 for like a year expiry, or if she's more targeted towards those stocks, she could like pick the tech industry or like the AI industry
Yeah.
and buy a put on that index.
Yeah, you've gone straight to the answer that I will go through, essentially, because this is about derivatives. But even before we go down that route, although it's an important point, although obviously what I do is derivatives all day, sometimes for an investor, it might be best to just sell a position, right?
I think the first thing we have to know is like what the client wants, where to ask.
Exactly.
Like,
Yeah, you have to ask questions.
Yeah, ask her like, what
Yeah.
do you want? What is your...
So, you've gone straight onto this point, right? You have to ask questions to your client, okay? So I'm going to come back to it, but you're very right in what you're saying. You need to ask the investor exactly what they want. But the problem is with wealth management clients, they don't know what they want, right? So often your job as a wealth manager is to try and get as much information as possible so that you can refine the set of solutions, right? If we put it that way.
Ask her like, what is her expected return of her portfolio and what type of risk she can take.
Yeah, exactly. So you could ask things like, what she's anxious about the market, right? She wants to protect things. So you could ask her, what magnitude of loss do you expect, right? What magnitude of loss really concerns you as an investor? So if the portfolio is down 5%, does that concern you? Probably not. If the portfolio is down 25%, it probably is going to concern her. That's most of the gains that she's ridden since the end of 2020. All right. So just to come back to some of the options, she can sell. Right? Why can't she just sell her Nvidia, her Tesla, her Supermicro exposure? They've done very, very well. There's a strong argument for selling. It's easy. She secures her gains. She protects against the losses, right? But there are some downsides. She gives up future returns. This is a big, big, big behavioral problem that wealth managers face. It's FOMO, right? And it might sound silly, but that is what drives a lot of the market moves today, right? If you look at how Nvidia traded after DeepSeek in January, down 20% down 20% at some point in that day. Even I bought some out of FOMO because I've not held Nvidia for the last 2 years, right? So this is something that really drives the market nowadays, and it's amazing to see with the amount of retail participants there are in the market. FOMO really, really drives things, and that can keep momentum in stocks for a lot longer than it can keep you solvent. So it's something that's very, very important. So although it's very easy to say, look, just sell your winners, what happens then is you as a wealth manager, if those winners go up another 20% this year, you're not going to look very good, right? You may lose a client at the end of the day. So it's a difficult thing to balance. She can do nothing. That's a choice, right? At the end of the day, I would argue that if she's anxious, it's not the best move as a wealth manager, right? At the end of the day, if the market does drop and you haven't suggested a solution, again, surefire way to lose a client. And the last one is to buy insurance, right? So you can buy some put protection, okay? There is another option which I haven't put here, which might be even simpler, is why don't you just short a future, right? If you've got long stock exposure, okay, you could completely immunize your portfolio by shorting a future, okay? So there would be some basis risk because her portfolio is not going to be the S&P 500. It's, kind of S&P 500 with different weights, etc. But a way to immunize against losses is you can simply sell a future. It's very costly. It will completely immunize losses. So essentially, if we assume there's no basis risk, if the equity market goes down by 10%, right, her portfolio is going to lose 10%, but her future is going to make 10%. Okay, so you'd have zero, essentially. So that's another way that you can quite easily hedge a portfolio without doing anything non-linear, right? So it's a little bit simpler for clients to understand. So we're going to look at buying insurance. Before we do, I want to just touch on hedging in general. This links in with what institutional clients also pay a lot of attention to. So in terms of hedging, there's always a trade-off. There is no perfect hedge, right? If someone offers you a perfect hedge, it's a con, right? In reality, it is. There are a lot of different characteristics about hedging that you need to trade off, right? So you can put them into two buckets. You can put them into contractual hedging, right? So that is a put. A put is contractual. There's a document which says this is the payoff I'm going to get, and I get it under these circumstances. So there are contractual hedges, okay? Buying put spreads, doing that systematically, that all sits in the contractual camp. This would be where wealth management clients sit, okay? Statistical hedges are a lot more involved. I don't have time to go through them today, perhaps in another session, but a statistical hedge is a hedge that effectively works off a market pattern, okay? So it would be something that delivers strong returns when you have particularly large move days in an index, for example. Right? So if you have an index moving by 2.5%, 3%, 4%, 5%, whether it be up or down, a strategy like market congestion, that does tend to deliver strong results in that sort of environment. Right? Intraday trend is another hedging strategy which sits in the statistical bucket. Okay? But generally,
Sorry, what is intraday trend?
intraday trend.
Yeah.
So intraday trend is simply if the market opens down, the market continues to go down throughout the day. Right? So that's intraday trend. The opposite of that is mean reversion. So if the market opens down, continues down, but then in the afternoon starts to rally again. Okay, so intraday trend, if you looked at some of the intraday movements during COVID, the market would open down 5%, but then it would close down 11 or 12% in the day. Right? They're moves that they're manic. I mean, the market, how it was moving then was quite crazy. But that is the best example of intraday trend. Okay?
Want to explain what's the difference between contractual and statistical hedge?
Yeah, of course. So contractual, that is essentially where the payoff is defined. Okay, so a contractual hedge is like a put option. Okay, so you get paid the difference between K and S, the strike and the spot price. Okay, that's a contractual hedge, right? You can put it on a piece of paper. I will pay you this if this happens. Okay, so we could implement a contractual hedge amongst ourselves. Okay, a statistical hedge is something that relies on a market pattern or a market characteristic. Okay, so by that definition, that market characteristic, it might happen on the next drawdown, but it might not happen on the next drawdown. Right? So on that condition, they are a bit less reliable. Okay, so we rate. This is very. I've just drawn this in Excel quickly. It's not something to live by, but ultimately, what we do with all of our hedges is we put them on this radar chart and we score them out of 10. Right, and we score them on various measures. So reliability is the first one. Okay, so that means essentially when you have market stress, is that going to pay out? Right. For contractual hedges, given they're contractual, they're a lot more reliable than a statistical hedge. All right. Retainability, that's an interesting one. Something that a lot of our clients struggle with traditional hedges. When you have a market drawdown, if we take COVID as an example, okay, during COVID, the S&P 500 was down 35%. Right? It was one of the best buying opportunities we've had in the last 8 years. Right? If your hedge doesn't retain value, okay, so if the market crashes, your hedge goes up in value, but then the next day the recovery, the hedge loses all of its value, you can't retain that cash, you can't retain that value. So you can't sell that hedge and then go and buy the S&P 500 at 35% lower. Right? That's the real value of hedging in a portfolio. Yes, it's going to help your portfolio dynamics, your risk and your reward, in particular your drawdown figure, but it allows you to monetize that hedge and go and take advantage of opportunities. So instead of sitting on cash, waiting for the opportunities to come through, you can run your portfolio quite hot, so with low cash, have a hedging policy in place, and ultimately with that hedging policy, you can monetize it when there's stress and go and buy the opportunities that present themselves. All right? Does that make sense? Yeah? That's a very institutional way of thinking. Wealth management people would not think of that way. Right? Wealth management, there's other considerations at play, which we'll come on to in a minute. And the last two are convexity. So that's essentially leverage, right? It's the amount of payout you get for a unit you put in. Okay, so something that is convex is beneficial for a portfolio because you can put a little bit of money down and you can get a big payout, right? Which is obviously a nice thing because it means that you can, it's cash efficient, put it that way, all right? And then you've got cost of carry. So cost of carry, if you are consistently rolling puts, right? If you're consistently buying puts and buying puts on things like NVIDIA, on Supermicro, it's going to cost you an absolute fortune, right? It will cost you 40, 50, 60% a year, right? So contractual hedges, huge cost of carry. Statistical hedges have very little cost of carry, all right?
Do statistical hedges have a higher retainability factor than contractual
They
hedges?
tend to, yes. It depends on which one you look at. But market congestion, for example, is something we've done a lot of work on over the last 5-6 years. Market congestion has very, very good retainability, and very happy to discuss it afterwards if you want, because it's quite an involved conversation. All right. But yes, in general, they tend to have good retainability. Okay. Right. So I'm not actually going to do the swap because can you see the
Yeah.
figures? It's good enough? Or do you want me to put the Bloomberg up?
That's good.
It's good enough? Okay, great. So I'm just pricing here blindly, right? So I haven't asked the clients what they want to do. They just said, okay, I'm anxious about the market. I want to protect my portfolio. So I'm going to price something on NVIDIA, okay, at the top here. The same screen that I showed before. We're pricing a put, we're buying it, and we're just looking at 3 months for the moment, okay? Bloomberg by default will give you a volatility mark, okay, so we've got a vol of 52, right, so significantly higher than what we were pricing before, right? NVIDIA is a volatile stock, okay, it moves by a huge amount. The day DeepSeek was announced is a classic example. You've got dollar rates, and you've got very little dividend yield, right, to be expected. NVIDIA pays no dividends. Okay, if I were to put Procter & Gamble in here, this dividend yield, the rate wouldn't change because it's still a dollar underlying. The dividend yield would be around 4%, right? So you can see, just pricing a 3-month option, right? So it's 3-month protection at the money, okay? So effectively, a dollar loss to NVIDIA is a dollar gain for you over 3 months, okay? It's going to cost you 10%, right? So think about that's 3 months. Think about the gain she has on her portfolio, which is about 40%, right? You're going to offer her something that's going to cost 10%, and you may not have a payout in 3 months, right? I would argue that's pretty shitty value, to be honest, right? I wouldn't suggest to buy a put on NVIDIA. The volatility is way too high. To sell a put on NVIDIA, perhaps, because if I sold that, I could gain 10% over 3 months, okay? And that is a reverse convertible, okay? Is it clear?
But wouldn't that just increase her exposure in that case?
Correct, yeah. So I wouldn't suggest it for her, definitely not, because yeah, indeed you'd be. But if I were to do it, is what I'm saying. Yeah, for the lady that's made a lot of money on NVIDIA, no, definitely not. That's for sure. Right, so we can obviously, as a way to cheapen the option, right? We don't feel it's very good value, so we can cheapen the option. And in fact, I'll have to do this one on Bloomberg because that's the wrong screenshot. So let's just. How did you do that, David?
Click on the other tabs.
Oh, yeah, great, perfect. So I'm buying a put. Let's just put NVIDIA in here. Right, so not necessarily comparable because the vol is a little bit lower today on NVIDIA, but 90 days, and we can just do, need to put here. Right, and let's change this to, let's do 20% out of the money, right? So you type 20% OTM. Right, there we go. So now we've priced, again, 3 months, but 20% out of the money here. So you can see the break even, right? The cost is a lot lower. Okay, so we've got 2 1/3%, right? It's significantly lower. But you're making nothing from the first dollar. You have to wait, in fact, for NVIDIA to fall by 20% to start making a payoff. But to recover the premium that you've spent, you have to have NVIDIA to start making a profit. NVIDIA needs to drop by almost a quarter, right? Which is a significant amount. It's a significant amount, right? Now, NVIDIA can do it with a vol of 50. It's very easy to do, right? But ultimately, again, the likelihood of a payoff for that option over 3 months is quite low, okay? So again, it's probably not the best solution for our client. Again, you can do the same thing for a 10% out the money. It's obviously going to cost a little bit more. Your break even is going to be lower. These prices were done a couple of weeks back, but nonetheless, the principle is the same, okay? So back to your point, which is a really, really good point to make, and it's exactly what I want to hammer home today. A wealth manager, the most important thing that they can do is ask as many questions as possible to their client, okay? You need to have a very, very good understanding of the requirements of your clients, what concerns them, the behavioral biases that they may have, okay? So for us to refine our hunt for a hedge, let's say, we're going to ask her a few things, okay? What risk do you want to insure against? Is your concern NVIDIA, Supermicro, or Tesla in general? Or is it actually that the market has dropped, the market has gone up so much that you feel that the market is going to pull back as a whole in the next 12 months, right? how long do you want your insurance for, and what are you willing to pay? I'm going to bucket those into the same, sorry. So evidently, an investor will always want to have protection for as long as possible, okay, and they want to pay as little as possible, right? It's quite evident. That's always the conversation when I say to a client, how much premium do you want to spend? They say as little as possible, right? And it doesn't help you as a wealth manager or in my job, but at the end of the day, it's very subjective, right? So an investor as to whether they think there's good value in that particular option or not. Okay, so often you won't get a very clear answer to these questions. Okay, but this one is a bit more relevant. What magnitude of losses do you want to hedge against? That will then allow you to see, okay, do I do an out-the-money option? Do I do a 10% out the money? Do I do a 20% out the money? Do I do a 50% out the money? Right? That will help guide you what sort of strike level you're looking at and ultimately where you should start with your hedging. All right? Now, in this conversation, what we've learned is she wants to hedge against the general risk, so the market itself dropping, not necessarily NVIDIA, Tesla, and Supermicro. And we've also learned that her equity portfolio has a lien against it, right? So what I mean by a lien, or a crédit lombard is what we call it in France, basically is you lend against an equity portfolio. Okay, so you as a wealthy investor, you put 20 million up, right? Your private bank or your custodian may lend you another 15, right, or another 10. So of course that's great because it amplifies our gains, but at the same time amplifies our losses. So in the event you have market drawdown, it can get a little bit stressful for an investor when they've got a lien against the portfolio. And unfortunately in the wealth management space, a lot of investors run their portfolios with a lot of leverage because that bankers are paid on that leverage. Okay, so there's a conflict that you have in this industry where bankers are incentivized to lend money to their clients. Right? They're incentivized, they've got a remuneration structure around it. But when the market does have some stress, the likelihood of a client getting a margin call can be quite high. Right, so a margin call would be where the private banks say, okay, we've lent you $15 million, you've got no equity left in your portfolio, please pony up another 10. Right? You can imagine that's quite a difficult conversation to have with a private individual when their portfolio's lost 20% already. Right? So the idea of there being a lien or lending against the portfolio is essentially driving that anxiety for drawdown in her portfolio, or potential drawdown in that portfolio. Okay, and as I said, she wants to pay as little as possible, of course. But in the end, you get what you pay for. Okay, so there is a very, very fine balance in this instance. Okay, any questions or comments on that?
I have a question.
Yeah.
Why would I take, like, if I'm like the client, why would I take a lien on my portfolio? Because I'm trying to minimize the volatility because I'm anxious during that period, right?
Yeah.
Wouldn't it be counterintuitive to leverage my position there?
Yeah, exactly. So it goes back to the options that she has. Right? Another option, given she's got a lien on the portfolio, another option is she could sell down the lending. Right? She could pay off the borrowing, and then she'd have no leverage anymore. Right? So that wouldn't remove her from the potential drawdown, right? But it would certainly remove her from a very large drawdown, which is exacerbated by the lending. So yeah, very much so. But that's very much in line with selling, right? She would sell some of the position, pay off the lending, and then she'd have an unlevered portfolio. Right? But yes, it's a good point. But the leverage would have been done at the start of the portfolio, right? But it is an option to the wealth manager. They can say, but again, you've got to look at the conflict there. The wealth manager is paid on the lending, right? So are they incentivized to tell the investor to pay down the lending? Maybe not. Maybe they're more incentivized to give her some insurance so they can make some margin on. Right? So you've got to understand there are lots of conflicts in this industry, and this is a good example of one, basically. All right, so I'm going to skip through this a little bit quickly because it holds some value, but it's not a huge amount. Right? So I want to first decide which underlying we're going to pick. Okay, you hit the head on the net already. We're not going to do NVIDIA or Supermicro or Tesla. The volatility is way too restrictive, okay? So what I've done here, just to give an example, is I've shown a basket, right? So the problem with doing an index is that it's not reflective of her portfolio, right? So there's a basis risk, okay? So her portfolio is very, very tech heavy, okay? Even if we did a put on the NASDAQ, right, it's still not the same. There is going to be some basis risk between the NASDAQ and the stocks that she's holding, okay? So to have a more pure hedge, you could look at a basket of the 3 stocks. Okay, so I've done 2 here. My benchmark is a basket of puts. Okay, so essentially they're individual puts, 3-month on those underlyings. Okay, and they're 5% out of the money for argument's sake. Right, so what's really interesting is that Supermicro, the price of a 3-month option is 20%. right? So Supermicro, it trades with a volatility of 100%, right? So we said NVIDIA had a vol of around 50, Supermicro is around 100. If you look at that stock on a chart, it's really, you have to have some guts to hold that in your portfolio, put it that way, right? It's extremely volatile. Right, so if I were to do individual puts, the basket price, right, so effectively the average of those three premiums, it's 12% for argument's sake, okay? We did that over the course of 12 months, it's going to cost us 50%, right? That's a huge amount of money to be paying for a hedge on the portfolio, even if it is a pure hedge and linked very much to where she's got the gains in her portfolio. The other way that we can look at it is instead of doing a basket of puts, we can do a put on the basket, right? So slight nuance in how it's called, but ultimately what we're doing is a put option on a basket of the underlyings. Okay, so we create a basket of those three underlyings, we weight them by a third each, okay, and then we can price an option on that basket. So again, a put on the basket 5% out of the money, it's priced at 8.5. So it's significantly lower than a basket of puts. Can anyone tell me why it's the case? And the answer's on the screen, but can anyone tell me why that's the case? You think about how a basket's composed, and you think about how those stocks move with one another. Exactly, right? So if those three stocks were perfectly correlated, right, there would be no advantage of putting them in a basket, right, because they move in lockstep, okay? The other side of that would be if you had two stocks and they were negatively correlated perfectly, one goes up by 5%, one goes down by 5%, your basket is 0, right? So your vol is 0, essentially, right? So if you've got stocks that have a correlation that's less than 1, you tend to have a dampening effect in terms of vol, so you're going to have a cheaper option price. Because again, there's a sense of higher vol, the higher option premium, all right? If we were to go one further, and we were to choose stocks from different sectors, so we'd take a Procter & Gamble, take an NVIDIA, and take a third stock that's from a low vol sector, you dampen this even more, okay? But again, you have to be aware that you've only got a third exposure to each of those, right? So it's probably not the best route to go down. We have saved some money here, okay? But still, it's the best part of 10%, and it's only a 3-month hedge, okay? So it's not necessarily the right way to go. So coming on to S&P or NASDAQ, right? This is definitely the way that we go straight away, go down the index route, okay? The S&P, from a hedging perspective, I'd say 95% of market participants, they hedge using S&P, okay? It is the most liquid options market known to man, okay? The volumes are, I mean, astronomical in reality. So I would always go down the route of pricing S&P options first. Now we could look, given we've got a tech spin on our basket, we could look at the NASDAQ, okay? The NASDAQ, it's very tech focused, it's 100 names, market cap weighted, okay? The sectors are very, very tech, semiconductor heavy, okay? So you would argue that volatility or stress amongst those three stocks that we've got is going to be more reflective of the NASDAQ, okay? But if we just look at NASDAQ compared to S&P, so what I've done here, just to give you a bit of visibility to where prices are, you've got out-of-the-money options. These are pure puts, right? Just no caps, nothing. It's just puts, 5% out of the money through 30% out of the money. So that's a strike 95, that's a strike 70, all right? And we've done the same for NASDAQ, right? So you can see clearly, same payoff, just different underlying, of course, different volatility mark, okay? NASDAQ in general tends to trade with a higher volatility than S&P. So if we take, just for argument's sake, 10% out of the money 12 months, 269 premium versus 370 premium, okay? So you can see the effect of volatility there on your option price, okay? In general, you're going to see a lot more volatility in NASDAQ than you are with S&P, okay? So given S&P is a more diversified index, that's one of the reasons why the volatility is lower. It's 500 names, but it is still very tech heavy, right? I don't remember the exact dynamic, how much NVIDIA makes up of the S&P 500 right now, whether it's 30% or, but it is a significant portion, right? The Mag 7, so these big 7 tech names, they make up an enormous portion of the S&P 500 because it's market cap weighted, all right? So there is obviously basis risk there versus our portfolio, but ultimately I think it's a risk that we can take on given the prices that we're paying for the options, right? If we remember back to that basket option, 3 months, it was costing 8 times that, right? So going down the route of indices is much, much better simply because the volatility market is lower. The cost of the insurance is lower, okay? The other thing to consider, which is a very important point, is that we know from the fact that she's got a lien on her portfolio, right? Invariably, I'll tell you this, her magnitude of loss is not going to be 5%. She's not going to care about that sort of loss, right? But if she got to the point where the losses on her portfolio are 25 or 30%, At that point, the private bank are going to be knocking on her door for more margin. They're going to call for margin on the account, and it's at that point where she might be forced to liquidate. Okay, so it's much bigger moves that she is worried about, essentially. So by that definition, you know that when markets crash significantly, everything correlates to 1. Right? Is that concept that you are aware of? Yeah. So invariably, you'll see equities going around globally. You'll see Eurostox going down, S&P going down, Nasdaq going down. But on a sector base as well, you'll see all stocks falling at once. Okay. You may see some factors doing better. You may see defensive doing better than tech, for example. Right. But ultimately, the correlation will be very close to 1. So by that virtue, that basis risk that we have between doing a put on the basket and doing an index, it's minimal, because the basket is going to go down by just as much as the index itself. Right? Does that make sense? 4 big moves, right, at the end of the day. Because you don't have, when there's real market stress, that's when you see everything correlate. Everyone is selling. Right? But when there's small moves like DeepSeek and so on and so forth, idiosyncratic moves, you're not going to see the same sort of hedging flows. Or protection, yeah, people running for the hills, basically. So, can we do better? The answer is yes, I would argue. So again, with these puts, they're uncapped, right? So she has all of the downside. So if the market went to 0, she'd get a payoff, right? A full payoff, I should say. You can buy a put spread, okay? So you can cap the payoff. So the way you do that, you bought a put here, right? So that's just a put on its own, and then you sold a put with a lower strike, okay? So again, this is the same payoff as this, right? So all these payoffs you can boil down to variations of that and variations of that. Okay? So if you follow this, if you do the sum of these 2 payoffs, basically you get the orange line. Okay, so this is a put spread. The first strike is 100, the second strike is 80, your max payoff is 20. Okay? It's the sum of the green and the red lines. Okay? That has significant ramifications for how that trades from a mark-to-market perspective, which we'll come on to in a minute. But at the end of the day, you would expect a cap to lower the cost of your payoff, like lower the cost of your hedge, because you don't have the full upside, essentially, for that hedge. Okay, you're capping your payoff. So I want to come on to, well, one other thing to explain. Does anyone know what a volatility surface is? Or the concept of skew? Is that something you've come across before? No? Okay, so volatility in the markets, and in particular implied volatility, which is what you use to price an option, it trades at different levels. And I'll show it you on Bloomberg, actually, because it's quite interesting. And if it's not a concept you know, it's a concept you should know. So this is skew. Okay, so this is a volatility surface for the S&P. So on the x-axis, you've got strike. So you've got 100 here. Okay, you've got a strike option 200 here. You've got a strike option 30% here. Okay, and these lines here are different levels of implied volatility, different maturities. Okay, so 3 months, 6 months, 9 months, or 1 year. Okay, so what you can see is that the more out of the money the option is that you strike, the higher the implied volatility mark. Okay, so this is known as skew. Okay, and essentially what it means is that the volatility at which you buy your first option, and your first option in our example was at 100%, okay, is a lot lower than the volatility at which you sell your option, which is at strike 80. Okay, so if you're selling an option with a higher volatility mark, right, that's better for you, right? At the end of the day, you're generating more premium from selling that option, so therefore you're going to lower the cost of your hedge by a significant amount more. Does that make sense?
Yeah.
Yeah? So the higher there is skew, the cheaper and the more advantageous it is to cap your payoff, right? And today, only recently in the last 6 weeks, skew has elevated quite significantly, right? So now capping your payoff on a put actually brings a lot of value to your structure. Okay, it cheapens the payoff quite significantly. So let me come back to. So that function, it's OVDV, just FYI on Bloomberg, right? So you can go to S&P 500 and just do OVDV, and you get the option surface. You can also look at the term structure. You can look at a 3D surface, and there's some crazy stuff that you can do in Bloomberg. So this is pricing of some put spreads. Okay, so I put here just for reference. These are uncapped here on the right. Okay, 6 months and 12 months. I've only done 6 months and 12 months because I feel 3 months is not really a sufficient time for hedging. Right? I feel a 6 or a 12 month would be more applicable to wealth management clients. Okay, gives a bit more protection. 12 months would cover more than the year.
Sorry.
Yeah.
I have to leave, but I also have two questions.
Yeah, go ahead.
Like I'm very interested in financial derivatives.
Okay.
I just want to know like what type of job I can apply for that I can
Yeah.
work with like derivatives.
So, and there's loads. I mean, the first place to go is the investment bank.
What type of job like traders or
There are trading jobs with derivatives. There are sales jobs with derivatives. There are structuring jobs. So structuring. So there's a few roles, right? When you put together a derivative package, there's a number of roles. There's the sales. Right? So they're the person that's selling it to the end client. So they're effectively saying which payoff you're going to get, so on and so forth. You've got a structurer, who's the guy that's basically pricing the structure. You've got a trader, who's the one that's essentially writing the option. Okay, so he's the one hedging it in the background. So you've got those three roles. And for me, the role that you go down, it depends on your skill set, right? If you love talking to people, right? If you are quite happy standing up in front of speaking to someone, sales is maybe the way to go. I started as a sales guy, right? Business development, a sales guy. If you're a little bit more analytical, maybe structuring is the way to go, right? And for traders, what skill set do you need as a trader? I mean, again, you need good analytical skills. The skill set would be quite similar to a structurer in reality, but you've got a slightly different role in itself, right?
yeah.
But all of those roles would be very much available in an investment bank, right? So in an equity derivatives desk, a cross-asset derivatives desk, all banks have them nowadays. It's not where I started. Right? I started at a brokerage, but nonetheless, that is a good route to getting into the industry.
Yeah, and if I have a job interview, what are the typical interview like technical questions they might ask?
There can be loads.
Do you
The
have
one that I showed, the rule of thumb,
okay.
right? So that's something that you can go back to. Any questions about sensitivities for options is a really clear one. So having a really good grasp of these basic concepts are really important. We always used to ask questions related to this, right? So that's what fueled the questions at the start. Okay, if your interest rates are negative, your interest rates are positive, if your dividend is this, if your dividend is that, what would be the price of the forward, right?
Okay.
These are questions that, going into a role like that, they should come very quickly to you. And if I were interviewing people nowadays, and as I have done in my previous role, those are the questions that I'd ask to check that the concepts are understood, right? Because there's two things about when you're looking at Bloomberg, right? You need to understand why that number is such. And so you need to have the theory behind and those concepts, the good grounding to make sure that that's clear. All right? Thank you for coming. All right. So just to finish off here, so we've got the reference on the right-hand side. You can see that evidently capping the payoff, so 95, 65, so it's your first strike at 95, your last strike at 65. So if we just do a straight 95 strike option or 5% out of the money,
Thanks.
no worries at all, enjoy your day. So you can see that evidently an uncapped payoff is going to be a lot more expensive across the board, right? It's logical at the end of the day.
Sorry, what do you mean first strikes?
This is the first strike. So that's the option you're buying, that's the option you're selling. Right, that's just the notation that we use essentially, right? So you can see that adding a cap is going to lower the cost of your payoff. That's a given at the end of the day. This is the old presentation, isn't it? It's not the case here because these are old prices. So ignore those prices. I repriced them this morning, but for argument's sake, these are too expensive because I used the wrong parameters. So ignore the 12-month prices, all right? But when you look at an uncapped payoff, it's going to be more expensive than a capped payoff always for the same first strike, right? I want someone to have a look at these prices, right? There's no wrong answer. Everything can be justified. So which of these put spreads would you suggest to the investor and why?
I would go for the 90-61 because their portfolio is very volatile. Like all of them have like 50 or 100% volatilities.
Yeah.
So like capping it at like 90%, 80%. So like I would not be like they would not like, as you said, they would not be concerned about such small moves in the market.
Mm-hmm.
So I would generally go with like a 60% sell call because then I would have more of a breathing room to just sell them that.
Okay, fair enough. So you've got 30% payoff here versus 20% payoff here, right? In terms of your max payoff. So I would tend to agree with you. This is the payoff that I would look at also. I debated in my head this payoff, okay? But in reality, the difference between the two is 15 basis points at 6 months. It's really inexpensive, right, to add 10% more payoff. The other thing to consider, which is something that we won't touch on today, is that how these move from a mark-to-market standpoint. Okay? We've assumed we're looking at the payoff, which is the payoff at maturity. But of course, your leverage in your portfolio is not dependent on when your option matures, right? It's moving every single day. So if you have the drawdown 6 months in, or if you have this drawdown just before maturity, then great. You're going to have huge amounts of sensitivity, right? Your delta is going to be very high, right? But if you have the drawdown in 3 months, the delta of this one is going to be significantly lower than the delta of this one, right? So that's how much the structure is going to move, how much the payoff is going to move versus the underlying itself, right? I would argue that given the magnitude of return or magnitude of drawdown she expects, indeed, having a cap that is much lower is more beneficial. Because at the end of the day, how your structure is going to move from a delta perspective, you're going to have a reasonable delta. It's not going to be huge at inception because it's struck 10% out of the money, your first option. But then as the market starts to fall, the delta impact that you have from the option that you have sold is going to have an influence, right? Because your maximum payoff is only 30% in this instance, right? Or 20% in this instance, okay? So if the market were to fall by 90%, let's take a really extreme example, okay? This one is going to have a better sensitivity than this one, okay? So by that virtue, mark-to-market is an important point. It's not something we discussed today. It's a whole nother session, essentially. But indeed, I would be looking at this strike. Now, 6 month versus 12 month. I'll come back to you. Which would you opt for, and why?
I'm not, because she's concerned about 2025 as a whole, I will go for 12 months, but I'm not sure if there's any math behind it.
So there is, and again, for another session, you have a lot more time value in this than you do in this, okay? So time value is theta, right? So it's the length of your contract, essentially, right? So your sensitivity is going to be much lower with a 12-month contract than a 6-month contract. I would argue that you'd suggest a 6 month. Cosmetically, the optics of it are a lot cheaper, right? It's 120, it's very cheap, okay? You can also then reassess the market in 6 months' time, right? So I've mentioned that skew is very high at the moment, so you're getting a lot of bang for buck from selling this option here, right? In 6 months' time, skew may be completely flat, so it may not make sense to do a put spread, okay? The corollary of that, or the other side of that, would be you don't necessarily know where the volatility market is going to be at that time. Okay, on the one hand, it may be super high. Okay, if vol's really high at that time, it's going to be very expensive for you to re-establish a protection. But on the flip side, if the market does continue to go up, volatility can get compressed again, and then it'll be as cheap, if not cheaper, to hedge your portfolio. Okay. The other consideration there is that if you have, and this is a big concern for our clients at the moment, if you have a market where essentially you have a 10 or a 15 or a 20% rise this year, or the next 6 months, this 90% strike, it completely moves away from the market, right? Because if you had then a 30% drop, you'd only just be hitting this strike, right? So there is some value in restriking your option and keeping it current, essentially, right? So if the market has rallied, in 6 months' time, this is going to expire worthless, of course, but you can then actually re-establish a new option where your strike is closer to where the market is actually trading in 6 months' time. Does that make sense? Rather than with a 12-month option being a little bit stuck, because it's going to have very little value if the market's rallied by 15 or 20%, and you won't be able to necessarily restrike it. All right? All clear?
To a skew point, like if my skew is currently relatively higher, wouldn't I get the point of reassessing the strikes, but if I was just to concentrate on the skew, wouldn't I want to lock in the 12-month period because I'm getting a better deal right now? In terms of
you make a good point. Yeah, you make a good point, right? So you would lock in that value that comes from the skew, right? I would argue, yes, from a quant perspective, you're locking in that skew, that's better for you, especially if skew then flattens over the next 6 months, because you're also going to get benefit from that from a mark-to-market. But when it's a wealth management client, having that flexibility of what to do, and also you're paying not quite double, right, but you're paying a significant amount more for that extra 6 months, I think it gives you a little bit more flexibility, right? Because if the crash comes in 3 months' time, you're going to be covered, and then you're not going to need protection again for the next 6 months, right? So I would argue that a 6-month hedge is really the ideal place, right? We don't ourselves see investors hedging beyond 12 months, right? At the end of the day, our investors, they're interested in covering their portfolio for a short amount of time. The longer it is tends to be the more expensive the contract. So to keep the premiums down, they tend to opt for shorter term options and then roll the position if they feel it's appropriate. Okay? All right. How is everyone for time, just out of interest? Everyone's good for time for the next sort of 20, 25 minutes? Okay, great. Some extensions, again, I can go through those in a little bit more detail if you wish to know afterwards, but I'm just going to move on to our instant application. So this is very much closer to what Gallium do day to day, a little bit more involved, but nonetheless, I think a little bit more interesting in my eyes. You don't have these behavioral biases that you have with wealth management clients, fortunately. So in this case, we've got an investor that's got a significantly bigger portfolio, so it's $2 billion. Okay, it's a pension fund. Okay, they've got a very long-term horizon. Okay, and their focus, their MO, really is to limit drawdown. Okay, a pension fund, they need to effectively pay out on their liabilities every single year. The pensioners that draw on their pension, they need to make sure they can hit the amount that they need to be paid in any given year. Right? So for a pension fund, a pension scheme, which nowadays is pretty much all pension schemes, they're underfunded. Okay, so they really, really need to limit the drawdown of their exposure so that they can hit the liabilities they need to pay each year. So by that virtue, the portfolio is reasonably well diversified, okay, but it's heavily biased towards fixed income. Okay, so it's diversified across fixed income, different sectors of fixed income, different currencies, etc. But there's no equity exposure. There's very little equity exposure, for example. Right? At present, the pension fund's quite unhappy with the macro environment. Okay, is unhappy with fixed income in general. At the moment, credit spreads. So credit spreads is effectively the premium you get paid for taking on the credit risk of a corporate. Right? So it would be the spread above and beyond a treasury bill, for example. Okay, credit spreads are very low, so the extra oomph you get from lending money to a corporate is actually extremely, extremely low at the moment. So there's not much carry in their portfolio. Okay, so by sitting on debt and holding it into maturity, so carrying the yield, carrying the coupons that you get, is not really paying you a lot nowadays. Okay, if you combine that with uncertainty over the path of interest rates, okay, and the volatility over rates, or the potential volatility over rates, clearly fixed income is starting to be a little bit less attractive. Okay, because if fixed income was carrying a huge amount, if you got a lot of bang for buck from sitting on that in the portfolio, you could stomach a bit of volatility, right? But if you've got returns which are super low, it's more difficult to stomach that volatility, right? So there are some options, okay? I'll go through this a bit more quickly. Same principle, right? They could buy equity, okay? I would suggest very much against that because you've got these two things here, higher vol, higher drawdown risk. That's not what a pension fund wants. They will not be able to pay out their liabilities. It does obviously offer higher returns. Dividend stream, I've put that there because broadly what you see for pension funds, they would be more likely to invest in equities that have good dividend streams, right? Companies that have good dividend streams, they tend to be the boring companies, they have high cash flows, so they return that cash to investors. And obviously that dividend stream is akin to a fixed income, essentially, right? At least if it's a stable dividend. So if they were to buy into equity, they would do definitely, high div paying stocks, which tend to be more defensive in nature. They could sell their fixed income, but then ultimately where they're going to get the return, they're going to get it from a money market. There's zero spreads in money markets, right? So if they just hold US dollars, for example, buy treasuries, the return is going to be even lower. Okay, so I wouldn't be suggesting that. So then our job is to look at alternatives. Okay, so alternatives provide decorrelation. They help enhance diversification. I've already mentioned that we're not looking at private equity and real estate, although pension funds do invest in that region, right? It's not to say that they don't, but ultimately we're here to provide a more liquid alternative. Okay, something that's cost effective. The big downside is they're complicated, right? There's a lot of risks involved that people aren't necessarily completely aware of, and my job and one of the MOs of Gallium is really to sort of pick apart that complexity and explain the risks that investors have in their portfolio so that they can make an informed investment decision, make sure that it's appropriate for their mandate. Okay, so we know that they're heavily exposed to fixed income. The performance drivers of fixed income, interest rates, so duration risk, okay, is one. So that's, Federal Reserve moving, long-term interest rates moving, so on and so forth. And you've got credit spreads. Okay, so that's, as we've said already, the spread above and beyond money market that you get paid for lending to a corporate, for taking on credit risk, essentially. Okay, so the risk-reward dynamics, it's kind of a low and slow. You have a pull to realize kind of effect. You have very little volatility compared with something like equity. So there's a really nice predictability around that. All right. what the pension fund is seeking in reality is that predictability, but with different performance drivers. Okay, so if you've got different performance drivers, you've got something that's diversifying, right? Because the to's and fro's of that particular asset are not going to be the same as fixed income in itself. Okay, can anyone think, based on, and I'll point straight to here, this here, how else you can generate a known return? Going back to what we discussed at the start, which is obviously options based.
Create a spread.
Say again, sorry?
Create a spread.
Do you want to sell or buy that spread?
Sell.
Sell, right. So yeah, selling options, right? So whether it be a spread, whether it be an outright put, or selling calls, for example. You can also sell calls. There's nothing wrong with selling calls. Okay, you would effectively sell a put on NVIDIA. It generates 10%, for example. Right? That's a known return. Of course, you take on the risk that NVIDIA falls, and you have to effectively deliver that stock or take a loss. But ultimately, that is a known return. Okay, so through selling options, we can have some elements of predictability. Okay, but when you sell options, you have completely different performance drivers. Okay, you have the underlying moves. Okay, you have the delta risk. So NVIDIA moving by 5-10%, that's going to impact the payoff of your option. Okay, you've got volatility. Okay, and of course, you've got anything that affects the forward. Okay, so with this in mind, one of the things that we've done with the strategy, and we'll comment on it in a minute, which is called volatility carry, we've essentially sold options, okay, both puts and calls on the S&P, and then we delta hedge against the underlying movements. Okay, so what that does is it immunizes the portfolio from the daily moves of the market, and what it leaves you with is a pure sensitivity to implied volatility. Okay, does anyone know what the difference is between implied and realized volatility? Yeah.
Realized volatility is historical. Implied volatility is like forward-looking. Yeah.
Exactly. Yeah, you're right in what you're saying. So to pick that apart a little bit more, implied volatility is the vol that you back out of the options market. So that vol surface I showed you, that's implied volatility. Okay. Realized volatility is the volatility that comes through in the price action. Okay. So take the S&P 500 for example. If it falls by 10% in a day, realized volatility is very high. Okay, volatility on a realized basis is nothing more than the magnitude of return. Okay, so if you've got big magnitudes of return, 10, 5, 8% for the S&P, high realized vol. Okay, if you've got 50 bip moves or 2 basis point moves, the realized vol is very, very low. Okay, so this relationship we'll have a look at in a little bit more detail. So this is implied versus realized. I hope you can see it, but in dark blue you've got implied vol of S&P 500, and in grey you've got the realized vol. Okay. You probably can't pick up on it because it's a bit far away, but the grey tends to trade below the blue. Okay, there are some periods, so 2020 for example, realized vol went significantly higher than implied vol. But this spread is an interesting one, right? So we take advantage of this spread through volatility carry. Okay, so what we want by selling options and delta hedging them, we want the difference between implied volatility and realized volatility to be as big as possible. Okay, that's essentially what we want. So why is that important to our pension fund clients? Well, this is reasonably predictable. Okay, in 80 or 85% of cases, implied vol will trade above realized vol. Right? Does anyone know why that's the case? Anyone? Comes back to insurance. Right? So when you're selling options, when you're buying options, you expect to pay a premium. Right? It's the same as if you buy house insurance. Right? You expect to pay a premium. Okay? So when markets are stressed, people go into the portfolio, people go into the market and they hedge. That pushes up implied volatility, right? So the demand for buying put protection or buying options in general pushes up implied volatility. Okay, so what you tend to see is because psychologically we are conservative as investors, we don't want to lose our money. People will go out and they'll hedge their portfolio. They'll go and buy options, and that means that implied volatility tends to trade above realized volatility. To put that into perspective, implied and realized vol hasn't had a big difference for the last 12 months, 15 months, for example. However, in October, just before the election, the difference between implied and realized vol was enormous, right? Because people were concerned about the outcome of the election, right? So people were hedging their portfolio. That drove up the demand for implied volatility, and ultimately that was something we took advantage of through the strategy. All right. So, just to explain a little bit what vol carry is a risk premia strategy. Risk premia is effectively a quantitative trading strategy. Okay, so what is a quantitative trading strategy? It's built to extract value from a market dynamic. So in this particular example, the market dynamic is implied volatility tends to trade much above realized volatility because of that psychological effect that I've just explained to you. Okay. Quantitative trading strategies is all computer-based, so it's systematic. I'm not buying and selling options on a day. We've written trading rules, we've given it to an investment bank, and they execute it on our behalf. Okay? Investment banks are very, very good at execution nowadays. They're not particularly good at the idea generation, which is where Gallium kind of comes in. So we're generating a steady excess return. Excess return, anyone know what excess return is?
Return over the risk-free rate.
Yeah, perfect. All right, good. I ask it because not a lot of people that I've interviewed know it, so it's an important point. So you've got total return, which would be including rates, and you've got excess return, which is above and beyond rates. Okay, so it really tells you the value out of the strategy above and beyond money markets, right? So we're looking at between 3 and 6% per annum. Okay, so that puts us in the peer view of fixed income. I would even argue high yield, essentially, right? And we're making excess return by extracting the premium between implied and realized volatility, right? So this is what it looks like. Okay, so you can see there's two distinct sort of scenarios here. Pre-COVID, okay, there was some return, but very little. And you got post-COVID, where there's a lot more return. And actually, just to put our own strategy, the last 2 months have not been very good. Right, the market dynamics that we've had over the last 2 months haven't really done very well for a strategy like ours. But just to pick apart some of the metrics, so if we look at the risk metrics, look, positive months over the last 12 months, 75%. Okay, so coming back to, well, if we look at drawdown as well as another one, right, the drawdown over 12 months was only 1.7%. So coming back to the predictability factor, coming back to our pension fund, this has low drawdown, low volatility, tends to be positive each month, 3/4 of the time anyway, and over 3 years obviously it's a lot higher, and it delivers you a decent annualized return, right? So that's 3.5, 6.3, and 7.75 annualized over different periods of time. Okay. Why was this a much worse period than this? Why? Simply due to the fact of where implied volatility was trading, right? For this period here, implied volatility was excruciatingly low, right? This was when we're in a zero interest rate environment for a lot of it. Money was flowing into the equity market, no bother at all, and implied volatility got completely crushed. So if implied volatility is very, very low, we're not making a lot of return from selling those options. Okay? Post-COVID, implied volatility went through the roof and has continued to be reasonably high up until probably 7 or 8 months ago. The opportunity set is a lot more right. Okay, you're selling options which have much higher premiums, so by that virtue you're going to make a bit more money and a bit more return over time. All right, all clear? Any questions? Run.
When you say, because when I look at it, the Sharpe ratio is negative for the 12 months.
Yeah. Good spot.
Is it because...
I was hoping someone's going to ask me that. So the reason why the Sharpe ratio is negative is because our fee is also in that product, right? So actually our fee is about 50 bits per annum. So in fact, if we removed our fee, it would still be negative, right? Because the return over the last 12 months has not been great, ultimately. And that's a virtue because implied volatility has been very, very low, right?
So even though I have like 3/4 of my months are positive, the rate that at which you're positive is not very high.
Because you're also accruing the interest rate, right? Okay. So that's ticking over, right? At the end of the day, all the way through. So that's why you've got positive months, right? And that's predictability, right? You have that month in, month out, all right? But yeah, indeed, the Sharpe ratio is not great at the moment. Okay? The answer we would have that for a lot of our investors today is that when market stress comes through, the strategy is built to deliver return. Okay, so it's not a hedge. Okay, a hedge is going to pay out directly if we have volatility and market stress. Here, you're going to have something that has low drawdown, right? So if we look at 2020, for example, S&P was down 35, this was down 7, right? So it is going to draw down, but it's not going to kill you. Okay, but at the end of the day, in that environment when the market is stressed, implied volatility shoots up, and then you start harvesting that cash. You start selling options at the best time. Okay, it's an interesting point to draw with this, right? With a wealth management client, with a wealth management client that buys reverse convertibles or sells puts, right? We always have the conversation how you should now sell the puts because implied vol is through the roof. But when implied vol is through the roof, the market is obviously down. What does the client do? But the market might continue to fall. When it's the best time to be selling volatility. With a strategy like this, you get over that behavioral bias because nothing's going to stop it. Unless you sell the position,